John Burr Williams' theory of investment value, detailed in his seminal 1938 work, The Theory of Investment Value, is one of the foundational concepts in finance, particularly in the realm of valuation. Williams' approach was groundbreaking because it systematically introduced the idea that the intrinsic value of an asset could be calculated by discounting its future cash flows. This method, which we now refer to as discounted cash flow (DCF) analysis, has since become a standard tool in modern finance. Below is a detailed summary of Williams' theory of investment value. Historical context. Williams developed his theory during a time of great uncertainty in financial markets. The Great Depression had left many investors disillusioned with traditional methods of valuation that relied on stock prices, dividends, or book value. Investors and economists were searching for a more reliable way to determine the value of a stock or business. Williams' theory emerged as a response to this need, providing a more systematic and logical approach to valuing assets, particularly equities. The core of the theory, discounted cash flow. At the heart of Williams' theory is the assertion that the intrinsic value of an asset, such as a stock or a business, is the present value of the future cash flows it will generate for its owner. These cash flows are discounted back to their present value using a discount rate, which reflects the opportunity cost of capital, or the risk-free rate, adjusted for the risk associated with the asset. Williams was among the first to recognize that dividends, and not earnings per se, should be the focus when valuing stocks, as dividends represent the actual cash flows received by investors. According to him, a stock is worth the present value of all the dividends ever to be paid upon it. No more, no less. This concept shifted the emphasis from accounting-based measures of value, like book value or earnings, to future-oriented cash flows. Williams defined the investment value of an asset as text, investment value, don't use sum left frac, dt, EJRT, right, where D_T represents the expected dividend in period T. R is the discount rate, often representing the required rate of return or cost of capital, and T is the time period number of years. This formula is the foundation of what is now known as the dividend discount model, DD, a specific form of discounted cash flow analysis, present value of future dividends. One of the key tenets of Williams' theory is the importance of future dividends in determining the value of a stock. While earnings may fluctuate and be subject to manipulation through accounting methods, dividends represent real cash that the investor can expect to receive. As such, Williams argued that dividends should be the primary focus when valuing equities. However, he also recognized that some companies, especially growth companies, may not pay dividends for many years, as they reinvest earnings into the business to fuel future growth. In these cases, Williams suggested that investors should estimate future dividends, even if they are expected to begin many years in the future. Williams' theory introduced the idea that stock prices should not merely reflect the current earnings or book value of a company, but rather the discounted value of all future dividends. This focus on future cash flows is a fundamental principle of modern finance, which still underpins many valuation techniques today. Discount rate and risk. Another critical component of Williams' theory is the use of a discount rate to account for the time value of money and risk. The discount rate reflects the return required by investors to compensate for the risk of owning a particular asset. The riskier the investment, the higher the discount rate should be, as investors will demand greater compensation for bearing additional risk. Williams' theory recognizes that different investors may have different required rates of return based on their risk tolerance, opportunity cost, and time horizon. This is an important insight because it implies that the intrinsic value of an asset is subjective, depending on the individual investor's expectations and requirements. However, Williams also suggested that in efficient markets, the market price of an asset should approximate its intrinsic value over time, as investors seek to buy undervalued assets and sell overvalued ones. Growth and the role of retained earnings. Although Williams focused on dividends, he did not ignore the role of retained earnings in generating future dividends. retained earnings, or profits that are reinvested back into the business rather than paid out as dividends, can be used to fuel growth, leading to higher dividends in the future. Williams recognized that companies with high growth potential might not pay dividends for many years, as they reinvest their profits to expand their operations. However, he argued that these retained earnings would eventually lead to higher dividends, which should be included in the calculation of the stock's intrinsic value. This recognition of the role of growth in determining value was another significant contribution of Williams' theory. While traditional valuation methods often focused on current or past performance, Williams emphasized the importance of future growth prospects in determining the value of an investment. This focus on growth is particularly relevant for modern investors, as many high-growth companies, especially in technology and biotech sectors, may not pay dividends for many years, but still have substantial intrinsic value due to their future growth potential, criticisms, and limitations. While Williams' theory of investment value was revolutionary, it is not without its limitations. One of the main criticisms of the dividend discount model is that it is difficult to apply to companies that do not pay regular dividends or do not have a predictable dividend payout policy. Many modern companies, especially in the technology sector, reinvest most of their earnings into growth initiatives rather than paying dividends, making it challenging to estimate their future dividends. Moreover, the theory assumes that investors can accurately predict future cash flows and apply an appropriate discount rate. In reality, forecasting future cash flows is highly uncertain, and different investors may have different expectations about future growth and risk, leading to different estimates of intrinsic value. Another limitation is that Williams' original focus on dividends may understate the value of companies that generate substantial free cash flow but do not pay dividends. In such cases, modern variations of the DCF model, which focus on free cash flow rather than dividends, are more commonly used to estimate intrinsic value. Influence on modern finance. Despite these limitations, Williams' theory of investment value has had a profound impact on modern finance. The discounted cash flow approach he introduced remains one of the most widely used methods for valuing stocks, bonds, and entire companies. The principles underlying his theory, the focus on future cash flows, the time value of money, and the role of risk in determining the discount rate, are now central to modern valuation techniques. Williams' work also laid the groundwork for more advanced models of valuation, such as the Capital Asset Pricing Model (CAPM), which provides a more sophisticated approach to determining the discount rate based on market risk, and variations of the DCF model that focus on free cash flow rather than dividends. Conclusion. John Burr Williams' theory of investment value revolutionized the way investors think about valuation by introducing the concept of discounted cash flow analysis and emphasizing the importance of future dividends. He provided a more systematic and logical approach to determining the intrinsic value of an asset. Although his theory has its limitations, particularly when applied to companies that do not pay dividends, it remains a cornerstone of modern finance. Today, Williams' insights continue to guide investors in their quest to determine the true value of an investment based on its future earning potential.